Well, we've made it. Week 10. I first want to say thank you very much for your patience and efforts during what's obviously been a different and difficult term. We've all had to adapt quickly, and personally, I appreciate the mature way that you've dealt with the inevitable technical hiccups that have cropped up. I really do hope that you've enjoyed the course and feel that you've got some Well, we've made it to week 10. I first want to say thank you very much for your patience and your efforts during what's obviously been a different and difficult term. We've all had to adapt quickly, and I personally appreciate the mature way that you've dealt with the inevitable technical hiccups that have cropped up along the way. I really do hope that you've enjoyed the course and feel that you've gained some skills or knowledge. Today I'll talk about our final class, and then I'll do a wrap up of what we've covered in the course. So Seminar 10 is on credit analysis. This uses a similar set of skills as equity analysis, but without an explicit focus on valuation. We're more concerned with the capacity of the firm to pay back any borrowings. This is going to be a key issue for a great deal of firms all around the world, given the impact of the coronavirus. First up, it's worth noting that the credit market is an order of magnitude larger than the equity market if we measure this in terms of turnover. This is despite the equities market getting all the love in the media. In the same way that our fundamental analysis for equities takes place in a wider context, so too does the use of financial statements within a credit analysis setting. For example, if you're in the position of a potential lender, you'll be wanting to consider what the loan is going to be used for and match that to the type of loan, the amount of loan, the time period of the loan, and the interest rate. You'll want to try and assess the borrower's capacity to repay the loan, and to do that by calculating its current capacity to repay to use forecast in determining the future capacity to repay. You then negotiate the specific terms of the loan should one be offered. We typically break down our credit-focused ratios in terms of a firm's ability to repay its obligations in the short term, and then those that look at the ability to repay long-term debts. We call these liquidity ratios and solvency ratios respectively. Liquidity is focusing on the short term and solvency on the long term. An important financial intermediary are the credit ratings agency. These firms provide information on the overall creditworthiness of firms and also rate specific debt issuances. The three big rating agencies are S&P, Moody's, and Fitch. The ratings agencies have come under sustained criticism from the dot-com bubble and bust at the start of the century through to the financial crisis of 2007 and 8. The criticism takes broadly two themes. Firstly, that the ratings are on average too high, and secondly, that the ratings agencies don't change quickly enough in the face of bad news. The main agencies have different scales, but the important cutoff point is the difference between what is classified as investment grade versus non-investment grade or speculative grade, also known as junk bonds. The ratings process is somewhat of a black box. We don't know exactly how ratings are determined, but we do know what sorts of factors are typically associated with different ratings. Another important use of financial statement information is trying to predict bankruptcy. These prediction models typically use some combination of ratios. The most popular is the Altman Z-score. This model has been refined over time, but is still not great at predicting distress beyond about 12 months. We'll have a look in class as to why that might be the case. So, let's do a quick wrap-up of what I hope you've learned from the course. First and foremost, you have to understand the business. That's key. The better you know what the business is doing and the industry conditions under which it is operating, the better your overall assessment and subsequent analysis will be. Think about what the main transactions are and what the key risks are and key opportunities. Don't be beholden to any specific analysis tool, but carefully consider what will best allow you to communicate your view of the company's circumstances. Your analysis of the business and its strategy will assist you in your accounting analysis. This step involves you assessing the extent to which the company's financial statements do a good or a bad job of reflecting the underlying economics of the business. This will vary due to accounting rules and the extent to which those rules give managers discretion. You'll consider the extent to which the firm has incentives to achieve particular financial reporting outcomes. Note that sometimes you'll identify conflicting incentives for firms. You use your accounting analysis to determine if you, as an analyst, can adjust the financial statements so that they can better reflect what you think are the underlying economics of the firm. You'll then be in a position to undertake your financial analysis or ratio analysis. We've gone through this in a structured way, starting from ROE, which is a summary measure of performance. You can also focus on the key ratios that best reflect the risk and the performance of your company. We do this to lead into our final analytical step, prospective or forecasting. We forecast the condensed balance sheet and income statement, and out of those forecasts come forecasts of free cash flows and residual earnings. We can then use those forecasts in our valuation models. Of course, once you have your valuation and you compare that to the share price, you'll have to consider the implications of any differences between your assessment of fundamental value and share price. Are the markets wrong or are you wrong? Your view on market efficiency will help you answer that question. So once again, I hope you've had an enjoyable term. Good luck in all of your exams and good luck beyond ACCT 3610.